What's been one of my favorite investments for the last few years? We're going to talk about that today. Hello, my fellow Ripplers. This is Chris Miles, your cash flow expert and anti-financial advisor. This show is for you. You work so freaking hard for that money, and you're now ready for that money to start working harder for you today. You want that freedom. You want that cash flow now. You don't want to have to wait 30 or 40 years, but you want to become work optional today, where you have enough passive income to work because you want to, not because you have to. But most importantly, I know you're not just here to get rich, although that's always a good perk, but you're here to live a rich life, because as you're blessed financially, as you have greater capacity and financial freedom in your own life, you now have a greater capacity to bless the lives of those around you. And that is why I'm here doing this show today. Thank you for tuning in. Thank you for creating your own ripple effect in whatever way that might be, and allowing me to do the same through you. Guys, thank you so much for tuning in. Of course, as always, if you love this show, please let us know, right? Go ahead and leave a review, whether you're listening to this on iTunes or Spotify. Leave us a review on YouTube, but please be sure to share that love today, because that ripple effect cannot happen without you. And if you want more people, especially as our goal is to have 2030, the year 2030, 1,000 families financially independent, we cannot do it without you and be able to spread that word. So please go do so today. All right, today I've got a special guest that, well, if you've been listening to this show, you know of Andrew, but you actually don't know him yet, but you will. But you know his company, Central Lending, because we've been advertising them for several months now. Andrew Boccia. Now, Andrew here, like, he is not only just the owner of this, but man, this guy has done like literally over 1,500 loans, right? This guy has been in the space. He's been lending. He knows what to look for. And by the way, we'll talk about this today. His default rate is almost seems too good to be true. That you're just gonna have to hear it from his own mouth today. So, Andrew, welcome to our show today.
Yeah, thanks for having me, Chris. Appreciate it.
Yeah, so tell us more about you, right? Because we've had people on this show that have done different types of debt funds, lending funds, and
hmm
whatnot, and they have varying levels of experience. I mean, how did you even go down this path, of doing this kind of lending?
Um, so you want me to start with just the real estate side?
Yeah, sure. Oh, you can tell us more. You can go back further. I mean, you don't have to say
So
like you were
I'll
born on
get
a Friday or anything like
yeah,
that,
yeah,
but
yeah. So I'll just give you a quick anecdote. Okay,
yeah.
so grew up in Detroit. Did Habitat for Humanity projects as a kid.
Huh.
My parents were both public school teachers. Kind of grew up there. Got into poker, interestingly enough, at an early age. So I was actually a professional poker player for about 8 years.
No way.
Kind
Wow.
of learned numbers, how to manage a bankroll, how to take calculated risk, all that kind of stuff.
Mhm.
Um, Sort of said, okay, that's enough of that. Segued into real estate about 10 years ago, and actually 11 years now. Been doing real estate full time for 11 years. Kind of took what I learned as a young kid. My parents did real estate sort of as hobbyists. They
Mhm.
use their teacher salary and save it and buy a rental here and a rental there, but they never did it as a profession, right? And I said, let me actually treat this like a real business and see if I can do this professionally. So I've been doing real estate all in 24/7, 11 years.
Mhm.
Um, we started our first fund. So I did real estate first 3 years. I did just my own money, my own deals. And then 3 years in, I started a fund so that my friends and family could co-invest with me.
Yeah.
And that fund's been running about 8 years now. And a couple of years into that fund, I started experimenting with loans. So we started out doing fix and flip, new build, rentals, spec homes, all that stuff. But a couple of years in, I got more interested in the lending side. What I really liked about the lending side is whether the market was up or down, the lending income was very consistent.
Mhm.
The lending income's only at risk if the market takes a significant dip, dip
Right.
deeper than your LTV is. So typically you're shielded with the first 10 or 20%. And then if your LTV is 75 and the market dips 75, then you're taking some L's.
Right.
But I really liked that, the day-to-day market fluctuations didn't really affect the underlying value of the loan. So that was really attractive. Another thing that's attractive about lending is just the return on time. So
Mhm.
the amount of time, I don't know if you've done a fix and flip, but the amount of friggin' time it takes to run into Home Depot and pick out all the tile and pick which walls have to stay and which walls have to go. And so
Yeah,
I'm looking at the average loan asset. My entire company probably spends 10 to 20 hours on a loan asset, just underwriting, processing, servicing, funding, closing, all that stuff.
yeah,
A fix and flip asset or a new build, like you're talking 1, 200 hours of just all the minutia and the management of it. So
easily.
at scale, it got really hard to flip, but lending was a stronger return on time, a lower risk profile, and then also just my temperament. I'm built really well for Excel sheets and for numbers.
Mhm.
I'm not built well for flips. Like I look at rehabs that our customers do, and they're really nice and creative and colorful and they look good. And when I flip a house, I feel like I can't, like, I'm going to pick the wrong stuff. Like, I'm going to
Mhm.
pick like the wrong flooring, and, the kitchen I put in might not even be a good looking kitchen. So, I think I'm better at the lending side on top of the other reasons I outlined for why we do it. So,
Yeah,
yeah, that's kind of, it just really fits my temperament well. And I love the strategy a lot.
yeah. Well, I'll tell you that much. I mean, that it's funny. I was just interviewed the other day on another podcast, and it was a real estate investor, but more dealing with active investors. And he was talking with his friend because he was kind of, not debating with me, but he was really challenging the whole passive income type of scenario, right? He's like, yeah, it's like I've never really found anything passive. And he even got to the point he got frustrated. He's like, he was talking to one of our mutual friends. He said, man, like I'm not finding anything passive. And our mutual friend said, you know what? If you're looking for passive, the easiest thing is to lend your money, to be a lender. He's like, that's probably the closest thing I've ever seen to passive. He's like, you're whining about all the work you're putting in as a real estate investor. Be a lender. Like being a lender
Mhm.
is way more fun. And I would say I agree. I mean, in today's market, especially, it's probably the one, if it's done right, it's probably the one of the best places to be having your money right now to get good, consistent, predictable income on the money you have.
Yeah, I mean there's levels to it, right?
Yeah.
I don't know if it's more passive than other forms of investing, sure, but it's not as passive as buying a 10-year T-bill, you know. You
Right.
buy, you buy a 10-year T-bill, you set it and forget it and collect your money in 10 years and you hope the government, doesn't go bankrupt. So that's passive in my opinion.
Your
Lending
company
is
kind of makes it
like
more passive for me, though.
yeah, lending is more passive than flipping, but if
Yeah.
you have a bad loan, now you're
Hmm.
flipping and you're in litigation. It's actually double
Yeah.
work because now you're foreclosing on the guy, trying to mitigate your losses. And then when you get the property back, guess what? Now you're a flipper. So
Hmm.
it's actually worse than just doing the flip to begin with.
Yeah.
Underwriting alone is, I wouldn't, it's not passive
Mhm.
because you're looking at entity docs, you're looking at background, looking at credit, looking at track record. You're making sure they can afford the deal. You're making sure the deal's profitable. You know, you're sort of buying a valuation. We buy a third party valuation, but then we still QC that valuation. So it's not the once the asset is originated, then I guess I would say yes, it is passive. Once
Yeah.
the asset's originated, if it goes well, and usually it will, then it is passive. But originating the asset is not passive. That's 10 to 20 hours of active work. And then if an originated loan performs, then I would agree that it's mostly passive. You still have to, if you're an investor, so some of our loans we sell, and some of the people we sell to want to view the construction draws, and so that's work. You got to
Mhm.
review the progress, and we'll give you the draws. Hey, we think so and so's approved for a advance of 50% of the construction, and you can trust our judgment, or you can do your own analysis, and like that's work, right? That's a
Yeah.
15-minute review to look at the PDF report and make sure he's paying on time and all this. So there's levels to it, but yeah, a an originated loan is mostly a passive asset for sure.
Yeah.
If it's performing and if it doesn't have construction draws. If
Right.
you add construction draws in, if you add maybe the need for an extension, or if you add non-performance in, then you need to invest more time into that asset.
Yeah. Well, let's talk about this. Let's go down this rabbit hole because I know, of course, you got that done for you option, like you just mentioned with central lending, which makes it a lot easier for us who don't want to do all this work. But let's talk about this. First, let's talk about what you've done in your lending. How many lending deals have you done now?
So we between DSCR and bridge loans,
Mhm.
I want to say we're around 1,200. And
1,200.
then
Awesome.
you add, yeah, if you add in our personal deals, our fix and flips, and our new builds, we're probably around 1,500 total sort of deals touched.
And how many of those did you have to go into litigation where you had to basically, foreclose on those?
So of our originated bridge loans, it's interesting. I just looked at this and
Hmm.
it was kind of ironic. I checked the dashboard that checks our completed loans.
Hmm.
And when I checked it, it was exactly 800 completed loans.
Wow.
And what we consider so I just got lucky, I guess. It was rounded off to 100 because I'm skeptical of like round numbers.
Yeah.
Whenever a borrower gives me a round number, I don't trust it.
Yeah.
So, anyway, I checked the dashboard. It's literally 800 completed loans. I was like, oh, that's interesting. It was. Um, so we track three results. Did we get our principal back?
Mhm.
Did we get which is a good result. You got all our
Yeah.
money back. Did we get less than our principal back, which is a short sale, or did we get a property back, which is an
Hmm.
REO? And result two and three are bad results, and
Right.
result one's a good result. And so, result two and three, I want to say we had about 15 of those. So it's about roughly about 2%. About
Right.
2% of the loans that have resolved poorly,
Hmm.
and the other 98% have resolved with us getting our principal back.
Got it. Yeah. So there was at least a loss involved there on the
Well, not
2%.
necessarily. Some of the REOs were actually profitable.
Right. Because if there's enough equity, you might
There's
be
a
able to turn it over
chance.
for a
There's a
profit.
chance. Now, usually it doesn't work out that way, but there is
Mhm.
a chance that the after we take the property back and sell it, you're actually in the good more than your principal and more than your default rate, more than
Yeah.
your interest rate, and more than your attorney fee. It's hard to do, but we have done it
Yeah.
in a couple of cases. Usually, an REO is a loss, though.
Right. So definitely, I mean, when you look at that from that standpoint, I mean, really, like, if you do 50 of these loans, it sounds like your odds are like there might be one, maybe
Plan
one.
on one. Yeah.
Yeah,
Plan on two and be happy with one is kind
that's
of what
right.
underwrite to two being bad. And then if one goes bad, you're kind of expecting that and maybe you're happy. I don't know.
Yeah. But see, I think that's incredible considering, especially the last few years, we've definitely had some stress in the market too. But what
Yeah.
I've noticed though, I mean, like I've talked to the other guys and I mean, you'll easily see sometimes 10, 15% default rates, in that kind of sense, and
Well,
here,
there's a difference between default rate on the active portfolio and
mhm,
loans that have resolved. So our
right.
default rate is less than 10%, but I would say more than five right now. And it fluctuates depending on, but a default rate is literally it's anyone that's matured, it's anyone that's 30 days
Past the
late.
date. Yeah.
Right. So we have loans that are quote unquote in default. It's March 20th. Loans that
Mhm.
were ballooned March 1st are in default, but our risk of
Yeah.
loss on those is almost nothing because a lot of those just, they're whatever, they're taking their time with
Yeah.
a payoff or selling it, or they don't want to pay our extension fee.
Hmm.
Or maybe they're in a refinance loan and that loan's dragging on for a couple of weeks.
Yeah.
So a lot of loans that are quote unquote in default in our portfolio, if they matured March 1st and it's March 20th, those aren't, in my opinion, like terrible assets. Now, if it goes into the matured 30 bucket, which is loans that matured February 1st, and now it's March 20th,
Hmm.
I'm getting concerned about those.
Sure.
I'm starting to weigh like, okay, what's the real chance of loss here? Are we at risk? So the longer it's been matured, the more concerned we are, definitely. But we also consider loans that are 10 days late in default.
Right.
So if they still owe us a payment for March, we have a 10-day grace period. So after March 10th, we consider them in default, but
Hmm.
those aren't necessarily all correlating to bad assets or losses. But definitely
Right.
there's like alarm bells that go off internally, and we pay close attention to those assets.
Yeah, of course. Yeah, like I said, like very like still a smaller percentage of those actually end up going to like option two or three, like you're saying, right?
Exactly. Yeah. So the way it works is like there's a 5 to 10% bucket that is like might be in default,
Hmm.
but then the ones that resolve adversely is about 2%. So we're
Mm.
trying to, that 5 to 10% that are sort of troubled, sort of they matured or like they're a little late or they're a little
Yeah.
sloppy with their payments.
If you've been following this podcast, you're probably looking for great ways to create passive income right now, right? Well, we got you covered here with Central Lending. Central Lending specializes in alternative investments that actually are designed to create steady returns and long-term financial security for you and your family. Now, they prioritize transparency. They love, building those strong relationships, giving you that confidence and peace of mind, knowing that you have your money working harder for you, so you don't have to work so hard for that money. You want to learn more how to do that? Go to centrallending.com and check out what they've got today to create your passive income and wealth creation right now.
We're trying to get our principal out of those and funnel those into the 98% of cases where we get our money back and not the 2% of cases where it's a negative result. So that's what
Yeah,
the servicing team does.
that's great. Yeah. So, what kind of due diligence do you do to get that low of really like that kind of low of risk that you have? Because yeah, and maybe this kind of ties in with you being a poker player. I don't know if this is something you've taken from the poker life and applied to your business. I mean,
Yeah, the street smarts, yes. The street smarts is
yeah.
very important, and that's something that you can't teach really.
Hmm.
So the biggest threat to our fund and our balance sheet and our profit, the biggest threat in the market right now is mortgage fraud.
Yeah.
So I need everyone to hear that. If you're buying a loan or if you're thinking about originating a loan, like the biggest threat to anyone's money is mortgage fraud. It's someone pretending to be a title company and they're not a real title company. It's somebody selling a property to themselves and like making up two different entity names and not telling you.
Yeah.
That's where you take the big L's. You take the big L's when it's some type of fraud.
Hmm.
So most of my effort is weeding out fraud. If I don't catch mortgage fraud like once a quarter, I figure I probably missed it.
Hmm. Interesting.
So yeah, I can just tell you stories of I had a deal. I mean, yeah, there's just lots of stories, but right now, like wholesaling is popular in real estate.
Mhm.
I'm sure you know what that is. It's so I saw a deal where a guy had a property locked up for 50 grand, and then he made a second LLC, and he did a second closing for 200 grand to this other LLC, and this house is going to cave over, after we got the pictures back, and
Yeah.
he's trying to do a loan off of 200 where we're going to give him like 150, but really he's buying it for 50. So he's just looking to scrape 100 off the table,
Hmm.
fill it with a tenant, slumlord it out, do an insurance claim, and kind of exhaust the market. Like this type of stuff's out there.
Yeah.
So most of my effort is in not losing money to people that are trying to rip you off from day one.
Hmm.
If somebody wants to pay you back and they're a good person and they fall on hard times, normally we can work that out.
Yeah.
Normally we can defer an extension fee, maybe give them a deal on the default interest rate, like waive some of that. Normally we can, we'll kind of convince them, hey, you need to list. I've even found realtors for people, or
Wow.
but listen, if you just cooperate with us, like we'll do the work, we'll find the realtors, we'll lift it as is. I even had a deal where we took it back deed in lieu. That was one of my 16 bad results in REO. I took a property back deed in lieu, and then we sold it to one of our best rehabbers because it was a tough project. So we took it
Hmm.
back deed in lieu, and then we sold it to one of our best rehabbers, who's a professional investor, for more money than the deed in lieu was worth. So we didn't even
Nice.
take a loss on that REO, and we
Hmm.
got two loans on the same deal. But
Yeah.
anyway, yeah, there's a lot of scenarios. The takeaway is if you lend to someone who wants to pay you back and puts good money down, um, the details will generally work themselves out.
Yeah.
It's an 80-20 rule. So 80% of the losses are from like really bad, harmful fraud.
Hmm.
20% of the losses, I would say, are from operator error. Someone taking on too big of a project, someone, yeah, just taking on too much of a project, maybe not having enough money, maybe not accounting for how difficult the project is. And I feel like a lot of people focus on the 20%, they don't focus on the 80%. So
Yeah.
Yeah, there's just like you got to avoid the landmines. If you avoid the landmines, like you're going to be fine.
Well, and before we went on the air, we were talking about how you even go into their personal credit and their financial situation too, don't you?
Yeah, so we'll look at credit. We'll look at we do all the regular stuff. Like we can
Mhm.
build an institutional loan package. Like we'll look at your credit, we'll look at your track record, we'll look at your bank statement, we'll see if you are borrowing like big wire transfers the week before closing.
Yeah.
We'll look at your Thomson Reuters background check, any tax lien you've ever had, any
Mm.
felony arrest you've ever had. Like we pull everything. So we'll
Wow.
do a full scrub and we'll build an institutional loan package, and we do sell to some of the institutional aggregators
Mhm.
which are in our space. So yes, we do the full, we can build a full loan package.
And then how much are you looking into the property? Like, because I know there's always the debate about, loan to value, even ARV, the after repair value and stuff. Like, how do you determine all of that? Because I think that's one of the places I've seen a lot of individual investors doing on their own where they make a mistake.
Yeah, so we look at four leverage ratios.
Mhm.
We have like this quadrant in the office. We look at four leverage ratios. So loan to purchase price is like our first leverage ratio, and
Mhm.
that ignores the property's value.
Yeah.
That leverage ratio doesn't care what it's worth. Could be worth $1 million, could be worth 100 grand. Loan to purchase price doesn't care. It just looks at how much money is the borrower actually putting in and how much are we putting in on the purchase day. Okay. That's the
Yeah.
first leverage ratio. The last leverage ratio is loan to final cost. So
Mm.
that's after we advance all the draws and everything else. At the end of the project, how much money is the borrower in for and how much money are we in for?
Mhm.
So a typical deal might be a $200,000 purchase price. Say I'm going to make the math easy because whenever I do mental math and it's complicated, I mess it up. So I'm
Yeah.
going to give you an easy one. So round numbers, right? So say the purchase price 100K and the rehab's 100K. If we do a loan of 180, that would be 180 over 200. That's a 90% loan to cost.
Right.
But if we hold back the 100 and we advance 80 on the closing day, that's 80 over 100. That's 80% on the front end. So that'd be
Yeah.
an 80% loan to purchase, 90% loan to cost.
Mhm.
Neither of those metrics care at all about the property value. They're both of those metrics care only about how much money is the borrower in for? What's their skin in
Yeah.
the game?
Exactly.
How much are they losing before we lose? And that aligns our interests very well because the borrower gets to keep all the upside if things go well.
Mhm.
But the counter of that is if things go poorly, the borrower loses all of their equity before we are threatened with with our investment. And on
Yeah.
top of that, we have a personal guarantee on all of our loans. So those are the first two leverage ratios. The next two leverage ratios ignore cost and only look at property value.
Mhm.
So the third leverage ratio is loan to value, and that's what's our advance. So in my example, $80,000 over today's collateral value. So say the collateral is worth 100K today, that'd be an 80% loan to value. And then what's our final advance, say 180, after all work is done over final property value. So say the property finished is 250,
Mhm.
our loan to ARV, I don't know what that is, 70% or something. I can't do the
Yeah.
math in my head, but you got it. So
Yeah.
those are the four leverage ratios. It's closing day ratios, cash in and over property value. And then it's when the project is done, cash in and property value. So
Right.
those are the four that we look at.
Yeah. Yeah. That's great. I like how you do that too. Is that
And
I,
all four need to be in check. And then obviously we look at, credit, previous experience, and all the details as well. We also look at local market experience.
Mhm.
Have you done another deal in that market?
Right.
People live in New York, they do deals in Boston, and now they're buying a friggin', a home that just flooded in Florida. So
Yeah.
we don't want them getting taken advantage of. So we will look at local market experience. We'll look at if you're a foreign national, so we look at all
Mhm.
those details as well.
Right. I like how deep you go. I mean, that's something that's really important. And I hope you guys right now listening to this, you're really taking this in because if you're to do this on your own, these are questions that I know I've asked when I've tried to do this on my own, but he's going. Andrew's going way deeper in this. I mean, he's even going as far as like doing a complete background check and everything else, which, you should be doing as well. I mean, really, you're basically doing the same thing a bank does to you in so many ways.
Yep.
Yeah.
Yeah. Yeah. It's I mean, we don't pull the tax returns and we don't
Mhm.
pull W-2. So we don't test personal income and we don't do consumer loans. So all of our
Mhm.
loans are considered business purpose. So we don't have like the same regulations that you would have lending to a homeowner for a consumer loan.
Right.
But other than the personal income test, we try to thread the needle between, I mean, there's a spectrum of how good of a loan can you build
Mhm.
by collecting paperwork and more paperwork, and then how can you create a smooth experience for your borrower who has a lot of options? And good borrowers do have options in this market. So I
Right.
spend a lot of time trying to thread the needle. I'm not going to sit here and say, we collect blood samples and every loan is, absolutely. I know every single bank statement that every borrower has. I don't. So we try to come up with a common sense balance. How can we protect our investor capital and provide a good experience for our borrower, but make sure we're not getting into trouble? And so I think our track record is pretty good. We try to go with common sense essentially.
Yeah. And that's really where your fund comes into play, right? I mean, you've got the fund with multiple loans in there, which obviously creates a little bit more diversification. But you even have the option too that somebody can even go on an individual loan on an actual note, right? Where they can actually hold the note. They could be the one involved, but rather than doing all the background, they're doing all that work. You're going through and doing all this. You said the 10 to 20 hours that you might be spending on one deal. You're doing that up
Yeah.
front for them, aren't you?
Yeah. I mean, if you buy a note, you have the advantage of sort of the entire underwriting's already done. You can see our whole
Mhm.
package. All you can see, you don't need to figure out how to do a credit report and run a background search and verify their experience and get property valuations. Like, all that's done for you.
Right.
The disadvantage is, you have high concentration into one asset. So
Mhm.
you buy two, like I can sit here and tell you for every 50 loans, one or two are probably going to go bad. Well, if you're buying two loans and one goes bad, you don't care about my other 48. You care about your deal. So you don't have any real diversification. So unless you're buying like five or 10, you can spread it out. It can be kind of risky to be
Sure.
have no diversification. But the advantage is you control that asset and you make the decision on that asset. So
Mhm.
if you come into our fund, you're kind of stuck with whatever decisions I make,
Yeah.
and you might not like the decisions I make, and you don't have a say in the lending decisions we make and in the assets we originate. And so if you're in our now, some people like that. They want to be passive and whatever along for the ride, and maybe they trust my judgment. But the advantage of being a note buyer is you don't need to trust my judgment. It's like
Mhm.
buying a house off someone you don't know. You can
Yeah.
look at the individual asset, look at the full underwriting package, and then make a decision, yes or no.
Right.
You kind of have that full control, and you kind of, yeah, you have full control of what you're in, and you get to see it all laid out for you before you make that investment decision.
Exactly. Yeah, I love it. I think that's great too because some people do want a little bit more control or a little bit, feel like they're in more control, and
Hmm.
be able to say, here it is. Here's all the research done for you. You take a look, see which ones you like, and I think that's a
Yeah, and we
great
have like
service.
100 to pick from. So we have, I mean, our balance sheet has, we've got 100 or so, more than 100 loans on the balance sheet now. So you can
Mhm.
say, I want, Florida, Georgia, South Carolina, and North Carolina,
Mm.
700 credit or higher, and no heavy rehabs. And we
Yeah.
can run like a little filter and show you, okay, well, now there's two. And
Yeah.
so what do you think of these two deals? So my capital raising team's great and they handle all of that, but we can kind of give you a menu to essentially pick from.
Awesome, man. Well, I know I'm gonna wrap up with this final question I have here. For those of you guys want to know how to get a hold of Central Lending, well, just a few minutes ago, you already saw the ad for it. So just go to the ad. If you
Yeah.
hadn't see it, go back, rewind. It was right there. But pretty much, we already advertised Central Lending for you in the middle of this episode. It interrupted Andrew right in the middle of his good stuff there. So last question for you, man. This is called the Money Ripples podcast, right? We talk about creating a ripple effect in people's lives. What do you feel is your personal ripple effect that you can create for other people? What do you feel you're here to do? You know?
Um, I mean, I'm having so much fun kind of building this and growing our team, I think that's my ripple effect. It's definitely building, creating an environment where our staff, our investors, our employees, our investors, and even everyone the investors touch, the investors
Mhm.
touch their contractors, their subs, the people they sell the house to, their tenants, the realtors they work with, the title companies, like, through our 1,500, deals, I mean, we've had a massive impact, and we're repairing, hundreds of communities across the country, and
Mhm.
we're impacting, tens of thousands of small business owners in various ways. So I think that's really our impact is the reach of our activities is pretty broad. So that's one way to look at it. The other way is just my core team, the
Mhm.
people that we share, that I share my office with, sort of allowing them a place to build a real career. That means a lot to me.
Yeah. That's true. It's almost unfathomable when you think about what kind of ripple effect you do create, because there are so many different lives that are being touched. Obviously, you're keeping the economy and the engine moving, as you're getting this happening, and you're beautifying neighborhoods indirectly.
Yep.
Even if you're not the one swinging the hammer, still the funds are what makes that possible
Yeah,
to
no,
really,
the
yeah,
capital goes to the investors. The investors go into the houses. The houses provide housing.
yeah,
They can either be sold to an owner occupant where previously it couldn't be financed, or it can be rented out and actually be
sure.
safe to live in. Then you got, realtors, title companies, insurance companies, contractors, all of these small businesses get supported through our activity. So to me, that's really, I think that's something to be proud of.
Yeah, I love it. I love it. Well, you're definitely doing a lot great work, and I love how your brain works. I love it. So, yeah, I mean, it sounds kind of nerdy, but it's true. Like I like how you think, and I think that's why a lot of our clients have also really enjoyed working with you too. So,
Yeah, it's been great, man. Appreciate the partnership and appreciate the
yeah.
opportunity to advertise and support the program.
Yeah. Well, appreciate having you on today. Everybody, like I said, go check out centrallending.com, see what you think, right? Test it out. But obviously, if you're looking for something to do that's passive, that can have a relatively low amount of risk, this could be something you can actually really be looking into. So again, we never give investment advice. Disclaimer here, of course, we're not giving investment recommendations, but definitely the biggest change that happens in your life is when you start to make those changes, when you start to act upon them. So go and make it a wonderful and prosperous week, and we'll see you later.